A pleasant day, everyone. I am Zenaida Bantilan, and today I welcome you to the Chapter 12 of our legal aspect in tourism and hospitality, entitled Laws Related to Tourism, Investment, and Finance. The learning objectives are enumerate the procedure in setting up a tourism oriented business, explain the laws governing tourism investment and financing tourism oriented project, discuss the business models applicable to tourism project, and enumerate the various taxes application to tourism related establishment. Also to discuss the limitation of foreigners in tourism investment. Act 7042, also known as the Foreign Investment Act of 1991, is a law in the Philippines that provides for the policies to be followed in the engagement of foreign investment and the procedures for registering enterprises doing business in the Philippines. These acts allow non-Philippine nationals to do business or invest in a domestic enterprise up to 100% of its capital unless participation of non-Philippine nationals in the enterprise is prohibited or limited by existing law. It also sets out the regulations for foreign investment in export and domestic market enterprises. The Act also includes a foreign investment negative list, which enumerate the areas of activities reserved to Philippine nationals by mandated of the Constitution and specific laws. Additionally, it mandates that all industrial enterprise regarding of nationality of ownership shall comply with the existing rules and regulations to protect and conserve the environment and meet applicable environmental standard. The law was approved on June 13, 1991. Investment in transportation, business, and public utilities. The Article 12, Section 11 of the 1987 Constitution of the Republic of the Philippines, under the topic of national economy and patrimony, emphasizes that the operation of public utility in the Philippines should primarily be under the control of Filipino citizens or organizations that are majorly owned by Filipino citizens. It also highlights the non-exclusivity and time limit of such authorization and the states of power to modify or revoke them for the common good. Lastly, it encouraged public participation in public utilities and restrict foreign investor participation in the governing body of these enterprises to their share in its capital, with the requirement that all executive and managing officer must be Filipino citizens. Investment in travel agencies and tour operators. The 2006 Investment Priorities Plan approved the Memorandum Order Number 211 Classified Tourism, which includes travel agencies or tour operators as preferred activities under Article 29 of the Omnibus Investment Code of 1987. This means that tourism-related businesses, including tour operators, are encouraged and given certain incentives to promote growth in the tourism sectors. In terms of accreditation, the following can be applied as a tour operator. First, a resident Filipino citizen. Second, a partnership organized under the law of the Philippines with at least 60% of its capital being owned by Filipino citizens. Third, corporations organized under the law of the Philippines with at least 60% of the subscribed common or voting shares of stocks owned by Filipino citizens and composition of its board of directors being at least 60% Filipinos. Investment on hotel, resorts, and other accommodation establishment. The Memorandum Order Number 211, which approved the 2006 Investment Priority Plans, classified tourism as a preferred activity under Article 29 of the Omnibus Investment Code of 1987. This includes the development of tourism economic zones, tourist estates, eco-agri-tourism facilities, and the establishment of tourist accommodation facilities such as hotel, resorts, apartels, pension houses, tourist inn, and similar establishments. For these tourist accommodation facilities to be eligible for registration under the Investment Priorities Plan, the applicant must satisfy the following criteria to the Board of Investment. First, if the applicant is a natural person, they must be a citizen of the Philippines. If the applicant is a partnership or any other association, it must be organized under Philippine laws and at least 60% of its capital must be owned and controlled by a citizen of the Philippines. If the applicant is a corporation or a cooperative, it must be organized under Philippine laws and at least 60% of the capital stock outstanding and entitled to vote must be owned and held by Philippine national as defined under Article 15 of the Omnibus Investment Code. Moreover, at least 60% of the members of the board of directors must be citizen of the Philippines. Second, the applicant must propose to engage in a preferred project listed or authorized in the current investment priorities plan within a reasonable time to be fixed by the board. Third, the applicant must demonstrate capabilities of operating on a sound and efficient basis and contributing to the national development of the preferred area in particular and of the national economy in general. These rules are designed to ensure that the benefits of tourism development accrue primarily to the Filipino citizen while also attracting foreign investment to help boost the tourism sectors and contributes to the overall national economy. Restaurants and other tourism related establishments, including department stores and shops, are governed by the laws on retail trade due to the nature of their business. In the past, these establishments were limited to operation and ownership by Filipino citizens or corporation and association fully owned by Filipino citizens. However, with the enactment of the Retail Trade Liberation Act of 2000, investors are now allowed to engage in retail trade, including restaurants and other tourism related establishments, subject to certain capital requirements. This information can be found in Chapter 10 of the Laws Regulating Restaurants and Other Tourism Related Establishments. Under the Retail Trade Liberation Act of 2000, there are exemptions that allows 100% foreign ownership participation in certain sales transactions. This exemption includes first is by a manufacturer, processor, laborer, or worker to the general public the products manufactured, processed, or produced by him if his capital does not exceed 100,000. Second, by a manufacturer of his product in a single outlet, irrespective of capitalization. And third is in restaurant incident to the hotel business. This exemption permits foreign investors to have full ownership participation in these specific cases. Tourism projects under the Build, Operate, and Transfer program. Republic Act number 6987 as amended by Republic Act 7718, also known as the BOT law, implements the state's policy to recognize the indispensability role of the private sector in national growth and development. The laws aim to provide favorable incentives to mobilize private resources for financing, constructing, operating, and maintaining infrastructures and development projects. The BOT law covers not only government infrastructure project but also government development project. It recognizes several schemes or contractual arrangement for project implementation including the build, lease and transfer, build, own and operate, build, operate and transfer, build, transfer and operate, contract, add and operate, develop, operate and transfer, rehabilitate, operate and transfer, and rehabilitate, own and operate. These schemes allow private sector participation in various aspects of project development such as financing, construction, ownership, operation, and maintenance. The specific arrangement depends on the nature of the project and the objective of the parties involved. Any individual, partnership, corporation, or firms, whether local or foreign, including joint venture or consortia of local, and foreign firms subject to the limit herein set, may operate or apply for a pre-qualification project covered under the provision of the Act. The qualification requirements of an entity to engage in any of the scheme under the BOT laws are first, for project implemented under the BOT scheme requiring a public utility franchise and prospective project, proponent and facility operator must be Filipino or in the case of corporation must be duly registered with the Securities and Exchange Commission and owes up to at least 60% by Filipinos. For project other than this, the prospective project proponent shall comply with the nationality and ownership requirements under the Constitution and applicable laws. Second, the project proponent of or facility operator may be Filipino or foreign owned for a project to be operated by the project proponent itself or owned by the project proponent by operated through a facility operator where operation of the facility does not require a public utility franchise. For pre-qualification, the contractor proposed to be engaged by the project proponent must be duly licensed and accredited by the Philippine Constructors Accreditation Board for Filipino contractors or by an equivalent accreditation institution in the contractor's country of origin for foreign contractors. The contractor transfers the facility to the government until concerned at the end of the fixed term, which shall not exceed 50 years during the construction stage. The contractor may obtain financing from foreign and or domestic sources and engage the services of foreign and or Filipino contractors. The financing from foreign sources shall not require a guarantee by government or government-owned and controlled corporation. In case of foreign contractors, Filipino labor shall be employed or hired in different phases of the construction where Filipino skills are available. All concerned infrastructure agency, including government-owned and controlled corporation and local government unit, shall include priority project in their infrastructure program. This priority project related to tourism have been classified as national priority infrastructure project. Preference may be given to Filipino contractors if they submit an equally advantageous bid with the same price and technical specification as foreign contractors. Project conceding in excess of 1 billion pesos shall be registered with the Board of Investments and entitled to investments provided under the Omnibus Investment Code. Project costing 1 billion or less may avail of incentives subject to inclusion in the current investment priorities plan of the BOI. The government may provide various forms of support or contribution, such as cost-sharing, credit enhancement, direct government subsidy, direct government equity, performance undertaking, legal assistance, and security assistance subject to existing laws, policies, rules, and regulations. The applicable laws for negotiation instruments and documents of title in tourism investments are Act 2031 Negotiable Instrument Act, Presidential Decree Number 115 or the Regulation of Trust Receipt Transactions and the Warehouse Receipt Law, Act 2137. Some important negotiable instruments and documents of title in tourism financing and investment includes first, promissory note, a written promise to pay a specified sum of money either on demand or at fixed future date with or without interest. Two, bill of exchange, an unconditional written order from one person to another requiring the payment of specific sum of money on demand or at fixed future time. Third is the check, a bill of exchange drawn on banks and payable on demand. Fourth, other commercial documents. This includes invoice sales, invoice purchase orders, bills of lading, warehouse receipts, and trust receipts. Letter of credits are also important in tourism financing and investment. They are instruments issued by a bank on behalf of a customer, authorizing the individual or firm to draw drafts on the bank or its correspondence under certain conditions. The Trust Receipt Law or the Presidential Decree 115 governs trust receipts, which are commercial documents used for financing importers and retail dealers. The bank releases the goods to entrustee but remains ownership and the entrustee sells the goods to apply the proceeds for the payment of their liability with the bank. Foreign exchange refers to instruments used for making payments between countries including paper currency, notes, checks, bills of exchange, and electronic notification of international debits and credits. In the Philippines, legal tender includes the Philippine peso and all notes and coin issued by the Bangko Sentral ng Pilipinas. Payment of debts in the currency other than legal tenders may be possible if there is a stipulation to the effect. Check, bills of exchange, and other mercantile documents do not have the same status as legal tender. A check, whether a manager's check or an ordinary check, is not legal tender, and an offer of a check in payment of a debt is not valid tender of payment. Checks, bills of exchange, and drafts may have the effect of payments only when they have been encashed. Under Central Bank Circulation Number 1353, the Monetary Board has further liberalized foreign exchange regulations on receipt and disbursement of resident in non-trade and trade transaction. Foreign exchange can be freely sold and purchased outside the banking system. Foreign exchange receipt, acquisition, or earning can be deposited in foreign currency accounts whether in the Philippines or abroad or brought out of the Philippines. Tourists can purchase foreign exchange from authorized agent banks up to the amount they have sold for peso. Departing tourists can also convert and spend pesos up to the maximum of $200 or an equivalent amount in any other foreign currency at prevailing exchange rates without the need to show proof of previous sale of foreign exchange. Certain categories of tourism in the establishment and non-trade foreign exchange earners are required to submit monthly reports of their foreign exchange receipts and disbursement to the central bank. This includes hotel, restaurants, resorts, tour operators, airlines, shipping companies, port operators, amusements and gaming establishments, and oil companies. In most deluxe hotels in Metro Manila, foreign exchange rates are based on the daily bulletin of the Bankers Association of the Philippines. They tend to use a cushion of plus or minus 52 for their transaction to prevent foreign exchange losses. The General Banking Law of 2000 recognizes the vital role of banks in the development of the national economy and emphasizes the fiduciary nature of banks, requiring higher standards of integrity and performance. Banks earn money by investing customers' deposits and are strictly regulated by the Bangko Sentral ng Pilipinas. Loan stipulation between entities and banks are regulated by the General Banking Law of 2000, but parties are free to include additional clauses, terms, and provisions as long as they are not contrary to laws, morals, good customs, public order, and public policies. Banks have fiduciary duty to treat the accounts of their depositors with meticulous care and are expected to exercise a high degree of diligence in their operations. Before granting a loan or credit accommodation, a bank must ensure that the debtor is capable of fulfilling their commitments. Loan accommodation are typically based on the borrower's need in the business, and collateral such as real property, chattel, or deposits are often required. Financial statements for the past 2 to 3 years are reviewed to assess the borrower's financial standing and ability to cover debt. Various commercial documents such as promissory notes, credit line agreements, real estate mortgage, chattel mortgages, surety agreement, trust receipts, and letter of receipts play important roles in shaping the financial arrangement between banks and borrowers. Banks may charge interest, penalty fee, and cost in case of default, and they have the authority to set off unpaid notes from the borrower's account. The book of the bank regarding the principal amount and computation of interest are considered conclusive. Foreign exchange regulations allow for the free sales and purchase of foreign exchange outside the banking system. Residents and tourists have certain limits and requirements for foreign exchange transaction, and reporting obligation may apply to certain categories of non-trade foreign exchange earners. Credit cards are access devices that allows individuals to obtain money, goods, services, or initiate fund transfers on credit. They are defined as cards, plates, books, or other credit devices used for obtaining credit for purchases and services. Open-end credit plans refers to consumer credit extended on an account, allowing individuals to make purchases or obtain loans directly from the creditor or indirectly through the use of credit card. The person has the privilege of paying the balance, and a finance charge may be computed by the creditor on an unpaid balance. The Access Devices Regulation Act RA 8484 aims to protect the rights and define the liabilities of parties involved in credit cards and other access devices. It requires disclosures of information such as annual percentage rate and fees associated with credit cards account. The law also regulates access device frauds, including producing counterfeit access devices, fraudulent use of unauthorized access devices, possession of counterfeit access devices, and more. In terms of protection, the law requires disclosures of information to applicants and provides exemption for certain disclosures in telephone solicitations. Rules are in place for the renewal of credit card account, including prior disclosures and manner of making disclosures. Device fraud is specifically enumerated, and penalties are imposed for various fraudulent activities related to access devices. In terms of incentives, the Investment Priorities Plan (IPP) and the Autonomous Region in Muslim Mindanao (ARMM) list identified priority areas for investment, including tourist-related activity. Fiscal incentives such as income tax holidays, exemption from taxes and duties, tax credits, and additional deduction from taxable income are provided to registered enterprises. Non-fiscal incentives, including employment of foreign nationals, simplification of custom procedures, and issuance of special investors resident visa for foreign investors. Investors can also lease private lands for up to 75 years subject to a certain condition and investment requirements. Special economic zones. Act of 1995, Republic Act 7916 establishes the legal framework and mechanism for the creation, operation, administration, and coordination of special economic zones in the Philippines. It also establishes the Philippine Economic Zone Authority or PEZA to oversee the development and management of these special economic zones. Under a memorandum of agreement between the Department of Tourism and PEZA, tourism development zones and tourism estates can be granted special economic zone status upon the registration with PEZA. Subject to the issuance of the required presidential proclamation, PISA considered the registration of tourist-oriented enterprises located in PISA registered tourism development zones and tourism estate with foreign tourists as primary clientele. The incentive available for enterprises located in special economic zones include up to 100% foreign ownership of locator enterprise, says income tax holiday for 6 years for pioneer firms and 4 years for non-pioneer firms. Non-pioneer firms located in less developed areas may be entitled to a 6 years. After the ITH period, the option to pay a special 5% tax on gross income in lieu of all national and local taxes except real property tax. Tax and duty-free importation of capital equipment required for the technical viability of registered tourism activity, special investor residence visa for foreign investors, employment of foreign nationals, and other incentive as determined by the PISA board. These incentives aim to attract investment and promote the development of tourist-related activities within the special economic zones. Business models. A joint venture is an agreement between two or more parties where they contribute money, property, or industry with the intention of sharing the profits among themselves. To form a joint venture, there must be a common purpose and a community of interest among the parties involved. Each party should have an equal voice in the performance and control of the venture. Joint ventures can have a juridical personality depending on whether they meet the qualification of a partnership under the Civil Code. However, in certain cases, joint venture may be established as a new corporation with the parties holding shares in the company. A management contract is an agreement where a corporation delegates the management of its affairs to another corporation for a specific period of time. The approval of the board of directors and the majority of the stockholders is required for a management contract. The condition for approval vary depending on the ownership and the control of the managing and managed corporations. Management contracts should not exceed 5 years for one term and they can be used for the exploration, development, exploitation, or utilization of natural resources. In a management contract, the operation control of an enterprise is given to another entity in exchange for a fee. This arrangement is commonly used in industries such as hotels, where multinational corporations provide their expertise in exchange for a management fee. Management contracts can also be used in industries where there is a lack of local skills or as an alternative for foreign direct investment. Franchising. A franchise is a privilege granted by a franchise service organization to a dealer to sell the franchisor's product or services in a specific area. This arrangement is often formalized through a franchising agreement which outlines the rights and responsibilities of both the franchisor and the franchisee. Franchising agreement may include benefits such as consultation, promotion, assistance, and financing, with franchisee typically paying a franchise fee. Franchising can take different forms such as product butorship or business format and involves the use of intellectual property such as trademarks and trade names. Time sharing. Time sharing is a popular form of shared property ownership commonly used in vacation or recreation condominium properties. It allows multiple owners to have rights to use the property for a specified period each year. Time sharing agreements involve the exclusive use of a vacation home during a specific time period, typically 1 or 2 weeks. Each time share unit is considered a separate estate or interest in real property, allowing for separate convenience and encumbrance. The cost of purchasing a timeshare depends on the selected time of year, and owners share the annual maintenance fee and property tax. Timeshare agreements are subject to federal and state statutes, which require developers to comply with disclosure and regulatory requirements. Taxes. Taxes on income. Individuals in the Philippines are subject to graduated rates of tax on their active business income, ranging from 5% to 32%. The tax rates are applied based on the income brackets, and individuals are eligible for personal exemption and additional exemption for dependent. Domestic corporations, on the other hand, are subjected to a flat 35% tax rate on their active business income, which will be reduced to 30% in 2009. Resident foreign corporations are taxed on their net Philippine source income at a rate of 35%, while non-resident foreign corporations are subjected to a 32 tax on their gross Philippine income. Special tax incentives such as income tax holidays and reduced tax rates are available for businesses registered in special economic zones. Value added tax. The Philippines imposes a 12% value added tax on the sales, barter, exchange, lease, or importation of goods and services in the course of trade or business. The VAT is based on the gross selling price or value of the goods or services. Input tax credits can be claimed for taxes paid on purchases related to the business. Certain transactions, such as export sales and specific exemptions, are zero rate or exempt from VAT. Percentage taxes. Persons with annual gross receipt not exceeding a certain threshold are exempt from value added tax but are required to pay a percentage tax equivalent to 3% on their quarterly sales. Different rates of percentage tax apply to specific industries, such as domestic and international carriers. Excise tax. Excise tax are imposed on specific goods manufactured or produced for consumption in the Philippines, such as alcohol products, automobiles, and luxury items. These taxes are paid in addition to the value-added tax, customs, and import duties. Custom duties are taxes imposed on exports or exports. Imported vehicles are subjected to customs duties, value-added tax, and ad valorem tax based on their book value. The tax rates and calculations are determined by the Bureau of Customs. Travel taxes are also imposed on individuals traveling out of the Philippines with certain exemptions for specific groups such as overseas contract worker. Duty-free Philippines is a duty and tax-free merchandising system that allows duty-free shopping for certain individuals, incoming and departing passengers, diplomatic personnel, and other eligible group can purchase duty-free goods within specific limits. The duty-free system is regulated by the Department of Tourism and the Philippine Tourism Authority. The Barangay Micro Business Enterprise Law. The Barangay Business Enterprise Act of 2002, RA 9178, aims to promote economic development by encouraging the formation and growth of microbusinesses at the barangay level. The law seeks to integrate informal sectors businesses into the mainstream economy by reducing bureaucratic restriction, providing government intervention at the local levels, and granting incentives and benefits to generate employment and alleviate poverty. Barangay microbusiness enterprise refers to any business engaged in the production, processing, manufacturing, trading, or services sectors with total assets not exceeding 3 million pesos, excluding the land on which the business is located. To register as a BMBE, an applicant must go to the office of the municipal or city treasurer where the business is located. The applicant filed out BMBE Form 101 and submit it to the office of the municipal or city treasurer. The application is evaluated and processing is completed within 15 working days. If the application is not processed within this period, the BMBE is deemed registered. Once registered, the BMBE is issued a certificate of authority as a proof of registration valid for 2 years and renewable for another 2 years. Registered BMBEs are exempted from income tax on income generated from their operations. Local government units are encouraged to reduce or exempt BMBEs from local taxes, fees, and charges. BMBEs are also exempt from the coverage of the minimum wage law, but employees of BMBEs are entitled to the same benefits as regular employees, such as social security and health benefits.